Hi, my name is Spencer Carenti. I run Alkaline Advisors, and today we will be reviewing our premium condo development financial model template. So to start, I'll give a brief overview of how our models work, and then we'll spend the rest of the time diving into the nitty-gritty of this specific template. We've got these tabs down below. The blue tabs are input tabs. If we click the blue tabs, you'll see we have blue cells. Those are input cells. All you have to do is plug information into those input cells, and the rest of the model auto-populates. We call this a fully dynamic model, meaning that you put your inputs in and outputs come out. You'll see we have a cover tab over here. All this info updates automatically. We have our brief disclaimer tab, and then we'll start with the inputs tab. On this inputs tab, I would say 95% of all inputs in the model are housed on this inputs tab, and it's broken out into sections. On the top, you can see project returns. These black bars are the sections, and if you scroll down, you'll see the returns stay in place. So you have property level returns, unlevered versus levered, or no debt versus debt. You have GP level partnership returns versus LP level partnership returns. We have brief general information. If you load in the info here, the rest of the model will populate accordingly. We have project timing. You could choose when the project's going to start. You can choose when we're going to have a certificate of occupancy. You'll say once construction is complete, and it'll auto-populate to show whatever month construction ends, or you can say a custom TCO, where now you can override that figure with an input of your choosing. Underneath, we have the sales and unit mix inputs. So because this is a condo development model, essentially what we're doing is we're going to be selling off the units. And depending on when you sell the units, ultimately that will determine when you're receiving back your capital to be able to pay off your loan, your investors, and ultimately determine what your profit is. So the sales schedule is really going to drive the return profile of the project. And as such, we've built out our sales schedule to have 3 different methods of helping us understand the frequency of the unit sales. The first is, let's say, standard. You'll see if we select standard, everything here grays out, and this unit mix standard section becomes able for us to input information. We can choose when the first pre-sale will occur for the units, how many units are pre-sold per month thereafter, and how many units are sold per month after TCO. We are then saying that we're going to be receiving 20% of the sales price in deposits. You can see a 20% deposit will be collected on all units sold prior to TCO. The remaining balance will be collected upon TCO. So any units that sell after TCO, there will be no deposit. You're just getting the full amount at the point of sale. So that's if we toggle standard, okay? If we say detailed, you'll notice information here becomes available for us to input data into. And we can choose the unit mix, how many of each units we have, the size of each unit, and then in terms of dollars today, so untrended, what is going to be the price per unit? What percent of these units will have upgrades? And what those upgraded figures would be in the sense of if this was $500,000 untrended market sale price and we had a 50% markup, essentially, that 500,000 would go to 750,000, and if we would have 5% of the 45 units now selling for 750,000 versus 500,000 if this said 500,000. And we can choose based off of each unit mix now, instead of one general assumption for how many units are pre-sold, when does pre-sale start, we can say, okay, 2 beds, the first pre-sale is going to happen in month 20. We're going to have 3 units pre-sold, and then units sold per month after TCO is going to be 2. So here we're going to say first units are pre-sold in month 20. We're selling 3 units per month during pre-sale, and then after we hit TCO, we're going to be selling 2 units per month. So you can customize your sales schedule in a little more detail, but still it's going to be X units every month in sales. And finally, we can choose custom. If we choose custom, you'll see this pre-sale section on the inputs tab is grayed out. And we can go to the sales schedule, and you'll see we have this custom sales schedule built out over here. Now, just so you can see, if we go back to inputs, what will happen is if we toggle anything other than custom, this custom sales schedule will be grayed out. And just so you can see, if we go to detailed, we go to sales schedule, now this is gray. But if we go back to custom to the sales schedule, it's not grayed out. And what you can do here is you could be very granular with choosing how many units you're going to have sold for each unit mix type in a given month. And you can see we have 45 total 2-beds. We've already pre-populated this to have exactly 45 units. But to limit the amount of user error in this model, if we, for instance, said we have 2 units sold here in month 20, you'll see we now have a check coming up. So everything lights up red and it'll say check. We have 1 extra unit. We're selling 121 of 120 possible units to sell. So you have to reduce this by 1. Now we can reduce another cell by 1, make this 0, and now it'll populate accordingly. So in terms of sales schedule, we have a snapshot of the breakdown here. And then we have the custom sales schedule here, which you can load in. But everything else is auto-populating in terms of untrended sales volume, trended sales volume, the deposits coming in, pre-sale schedule and sales schedule, release schedule, because you can only release the units upon TCO when individuals can move in. So everything's broken out accordingly in this tab. You can see the flow of capital. If we go back to the input section, the other piece of the sales and unit mix inputs that I haven't mentioned yet is the deposit collection schedule. So with the deposit collection schedule, what we've done here is we've given the user of the model the option to choose when they're collecting the deposits and what that looks like. So for instance, if we can say deposits, we're able to collect 20% of deposits and we're custom or we're detailed, what happens here is we can choose what the deposits look like. So if we're collecting at once, the first collection is at first contract execution. So we're essentially collecting all 20% of the deposits when you're selling the unit, right? If it's pre-sale. If we have 2 collections, we can say, okay, we are going to collect 30% of the 20% at the point where we are signing the contract. And then in this scenario, we're going to collect the additional 20% in after X amount of months. So in this scenario, we're saying the final collection would be some arbitrary figure. Here we're saying month 18. It doesn't have to be arbitrary, right? It could be based off of any sort of agreement you have with the buyer. If you're hitting certain hurdles or certain milestones throughout the development period, the buyer might have to give a different percentage of their deposit at a different time. So here we'll say the rest of the deposit has to come in at month 18. But you can make that month 20, month 40, you name it. If we want 3 separate collections, now we can say first 30% of the 20% comes in at the time you're executing the contract. The next 20% of this 20% comes in at, let's say in this scenario, we're saying month 6, or we can say month 17. And then the remaining balance comes due on month 20. So there are different ways we can structure when the deposits are actually coming in to our capital at a developer's perspective. So this is the sales and unit mix input section, and happy to go through it in more depth. If you have any questions, please reach out specifically. Then presumably you're going to finish construction and you're still going to have some units on your books. Once construction's completed, you're still going to be selling these units. So we built out carrying costs. The carrying cost section is just going to show what you're going to owe as the units are on your books before you sell them and move them off your books. And we can build carrying costs a number of different ways in terms of how we're allocating capital to each line item, different ways. It's all going to be percentage drop down. We can say, is it a percent of value of the unit? Is it a percent of revenue if there's other revenues? Is it just a total dollar figure amount for cost, or is it a price per unit? There's a number of ways that we can build this out. And in terms of frequency, we can choose when the costs are hitting and how they're allocating. Is it a one-time cost? Is it every year you're paying a certain amount? And then how many months after the delivery of the unit are you going to have to start paying this fee? So right now we're saying upon delivery of these units, we're going to start paying immediately. But if you want to delay by 6 months, 12 months, you name it, you can do so here. Then we have sale price growth. So we're going to be trending the units up on an annual basis based off of a percentage figure, which you can allocate here. Is it 2% year 1, 2% year 2, 3% year 3, build it all the way up to year 6 plus. Next, we're going to talk about the financing input section. For the financing input section, we have a few different toggles and a few different options for a group to analyze. And I'll just show you what they all look like right off the bat. But essentially, we're providing the opportunity for a pre-development loan, a construction loan, and an inventory loan. We also have the option for pref equity, which would come in with either the pre-development loan and or the construction loan, depending on how you want to structure it. If you don't have pref equity, or mezz debt, if you want to call it, you can toggle this to no. And if you don't have a pre-development loan, you can make this 0% LTC. But essentially what's happening is you're first going to draw down your equity. Once your equity is drawn down, the debt from the pre-development loan is going to come in. You can see over here, you can choose of these costs which are financeable and which are non-financeable. And what's going to happen is once you load in the pre-development budget inputs and you load in the other budget inputs for the construction loan, you'll put into place the pre-development loan. And then with the construction loan, if you're taking out a construction loan, you will actually pay down the pre-development loan with proceeds from the construction loan, so that pre-development loan will no longer come through. And then once you have an inventory loan in place, presumably the units are delivered, you're able to refinance out of the construction loan and or pay off some of the construction loan by sweeping proceeds from the condo sales. The inventory loan would pay off the construction loan if it's even in place, if you don't have enough proceeds to pay it down from condo sales at that time. So we have goal seeks, which we can build out here. L10120 by changing M101. So just to do that, we would go to data, what if analysis, goal seek. We're going to go to L101 to value 0 by changing M101. So that's going to be this. We want this to be 0 by changing that. We'll click OK. Model will iterate. You'll see now we have the pre-development cost of 10.8. Why? Because it's taking the total pre-development cost and including interest reserve. And once we include the interest reserve, now we're funding the whole pre-development cost plus any vertical cost that's down below, hard cost, soft cost, any other costs inclusive in the budget. So now we have a vertical loan or a construction loan. You can choose if you have deposits from pre-sales funding some of the construction costs. If not, you would have to borrow more or provide more in equity. If so, you're able to use some of those deposits to fund the construction of the building. We can add loan fees. We can say if the loan is fixed or if it's floating. And then with inventory loan, similar, you can say there is none. If you don't have one, what the loan to value is, when are we issuing the loan, in what month, and we can calculate the value of the inventory loan based off of the untrended unit price or the trended unit price. And you got to remember, we're going to load in the untrended market sale price right here. If it's detailed, and if it's detailed, it's just standard. You're going to load in the untrended sales price right here, and that's going to dictate what the value is at the time of refinance. But you can choose if it's trended or untrended or dollar per unit. So you can, if the lender says, hey, we'll just assume all these units are X dollars, we can load that in here, and then you can take an LTV of that figure and fees, and then you can choose if it's fixed or floating. Finally, we have the sensitivity analysis. Here we're sensitizing loan to cost, and we are also sensitizing selling costs, and we can see how that impacts the profit, equity multiple, and IRR at a project level, a GP level, and an LP level. So this is actually going to be the loan to cost as it relates to the construction loan. So this is if we get a 60% LTC versus a 57.5 versus a 65%, and different selling costs with the individual units. And we're going to then see how that range of costs impacts our return profile here. It's the levered IRR. And just so you know, this is red. Because this is red, it's not accurate right now. Why? Because we need to refresh the data table. And the way to refresh the data table is you go up to the toolbar up here and you'll click formulas. Once you click formulas, you can click calculate now. And then what'll happen is it'll iterate until this goes away, and then this is now populated accordingly. So this is the inputs tab. I know it's a lot of information. We have the SOFR curve down below, but it is really straightforward. And ultimately, as I said, a majority of the inputs are on this tab, or the sales schedule tab if you have a custom unit sales schedule. Next tab that we'll talk through is the cash flow tab, or the CFTab. Here, zooming out, you'll see it has all of the monthly cash flows. We have pre-development costs up top, then regular construction costs, then the draw schedule, first equity for the pre-development loan, then we have equity for the construction loan, we have pref equity, we have pre-development loan, we have construction loan, and you can see how the capital flows accordingly. If we come up here, you can see equity for the construction loan starts coming in month 25, because that's when we're starting to pay for the budgeted items in construction versus pre-development. So we have to come out of pocket more at this time, but we're not coming out of pocket times 0, right? So it enables us to push back the amount of equity we're deploying, the amount of equity we might be raising from LPs that we're deploying, also that in terms of time value of money, the IRR, whether it's ours or an LP's, can be more efficient. And then what we'll show is underneath we have in the inventory loan, we have the inventory as it's available, cumulative units released versus available. If we click this button, you can see as it relates to the individual units, when the units come online, how many have been sold, and so on and so forth. For the inventory, if we click this plus sign, you'll see all the units become available in month 46. But you'll also notice that if we go back to the inputs tab, we're saying that we have a TCO in month 48. So the units are technically delivered in month 46, but we don't have TCO until month 48. But if we do completion instead of delivery, now they are delivered in 46 and we have TCO in month 46. We go back to the cash flow, you'll see the units that have sold are off our books. We've never had them on our books because we never had to hold them. And then in terms of units that we had to hold, is only a couple 3 bedrooms and 2 bedrooms based off of the sales schedule. And then you can see we're 100% sold in month 49. So it's a good way to document where we are in the process and how everything's looking. And obviously this will drive the costs as it relates to our carrying costs, right? It's directly proportional. We have carrying costs right here, and that's being driven off of the units that we have on our books. Underneath, we have the sales schedule. You can see we have pre-sales, we have TCO in month 46, and then in month 47 thereafter, we have post-TCO. This will all update automatically. The colors will change automatically, and you will be able to get a better sense of when in the timeline everything's selling and where we are in that timeline as well. Sales summary underneath in terms of deposits collected, remaining sale value, total sales, selling costs, and then we have net proceeds. And then we have reserves, deposits used to fund construction. Again, if we're able to use the deposits to fund construction, they'll show up here. When we have that toggled to off on the inputs tab, nothing will show up here. And then finally, we like to think through our models in really 2 variables: contributions and distributions. Contributions is what you're spending. Distributions is what you're receiving. And we think of contributions in 2 ways. The first is capital to build, right? What are we actually spending on the project itself? That's contribution 1. And then we call that initial contribution. And then we have contribution 2 is cash shortfall, operating shortfall. So even after we've built the project, are we going to have to come out of pocket for anything else? Like carrying costs, all of that should be capitalized in our project. So those are the 2 contributions in terms of the equity required from our perspective. We build that out here. And then in terms of distributions, we are doing it based off of refi and disposition. Disposition being the sale of the units, refi being if we're able to take any cash out for the inventory loan to pay off the construction loan. And then all of the funds in here flow through to the bottom line. Unlevered cash flow is our bottom line, not inclusive of debt, and levered cash flow is including debt. But before I leave this page, the only inputs on this tab are going to be in the pre-dev cost section, in the construction cost section. You'll see these plus signs. If you click one, you can see the makeup of the pre-development soft costs. See right now we only have pre-dev soft costs. Very quickly, if we go back to inputs, scroll down to pre-dev soft costs, let's call this A, and then let's call this B, for instance, and let's make this 1.5 mil as well. We'll go back to the cash flow. Now you'll see A is 1.5 mil, B is 1.5 mil, and we can say we're going to start incurring the total budget cost in month 1, and we're going to end in month 4. And that means that 1.5 mil is going to be allocated evenly over 4 months, evenly if we have straight line allocation. If we don't have straight line allocation, we can have a bell curve, and that means that there will be a moderate or steep bell curve from months 1 through 4, or you can do months 1 through 10, and then it'll update automatically. Or you could do custom, and if we have custom, we'll go to the custom cash flow tab, right? You might have a custom construction schedule, just like you have a custom sales schedule. You'll notice we have one green line in this custom cash flow tab. That is because it's showing us that we have custom costs only in the pre-dev soft cost section. So if we expand that, you'll see pre-dev soft cost A is not here. Why? Because we don't have custom costs. We only have it in B. So if we go here to soft cost B, first of all, you see this is a good example. We have errant data here. Well, that's not an issue because it's not pulling, right, 500,000 in month 2 for what would be soft cost A. Because we don't have custom selected, this is not coming through. So actually what we can do is, because it seems like this is going to equal 1.5, we can just say, okay, we have those same cost allocations in pre-dev soft cost B. If we go back to the cash flow tab, the CF tab, and we go here, you'll see now we have 500,000, 200,000, and 800,000. 200,000 and 800,000 in pre-dev soft cost B. And pre-dev soft cost A, even though we have those same figures, it's not pulling through because we don't have custom selected. So if we turn custom off and did bell curve, now it's also not pulling through. See, start month 1 and month 10. So that's a cash flow tab. And as I said, everything rolls up into the levered cash flow line item. This line item will flow directly into the partnership returns tab. Calculate the GP/LP return metrics and hurdles. And we can choose what % of the equity is funded by the GP. The LP will make up the remaining balance. We can choose how many hurdles there are in the promote structure between the LP and GP. You can say there are no hurdles, so it's all pari passu. There's one hurdle, meaning that the pref rate of 10% needs to be hit for the LP before the GP receives their promote. Doesn't even necessarily need to be a promote, though. Right now it would be a promote, right? So the GP would get 20% of the returns over 10% preferred return to the LP. They get that free 20%. Then there's 80% of the pie, let's say, of possible distributions left over. Of that 80%, the GP gets 10% because they have 10% of the equity in. So 10% of 80% is 8%. So you'll see the total distributions to the GP would be 28%. But if you don't want to calculate promote and you just want to say, hey, everything after 10%, the GP will get 20%, we can change this promote to just split. And now you'll see the distributions are 20%. So it's not a real promote. And if you have more hurdles, you can add more hurdles, different promote structures, and things will be allocated accordingly between GP and LP. Then in terms of interest and equity, we can choose the compounding frequency for the pref. Is it monthly or is it no compounding? We can choose the distribution frequency for the LP. Are we making distributions annually, quarterly, or monthly? And then the equity contributed from the partnership return, is it all capitalized up front? More likely than not is my guess. But if you are capitalizing it on a monthly basis, whenever costs are incurred, you can click incurred and then things will update accordingly, right? So now you have more equity needed in month 25. But if we say upfront, that all goes away and it's all front loaded. Perfect. So this is the partnership returns tab and the calculations are underneath. We have error checks over here. It'll show you what hurdle percentage you're at. Did you achieve the hurdle, right? So if we do 3, I actually don't think it hits in this scenario. If we do upfront, yep, it does not hit because we need a 15% hurdle and we're maxing out at 12.11%. So that's the partnership returns tab. And then finally, we have the investor summary and the lender summary tab. So on the investor summary, you'll see Scarlet Begonias is the project. Jack Straw LLC is the sponsor. It is on 123 Shakedown Street in El Paso, Texas. And you'll see if we go back to inputs, all of that is pulling from up here. Scarlet Begonias, 123 Shakedown Street, El Paso, Jack Straw LLC. And that's also what flows through to the model here, Jack Straw LLC, Scarlet Begonias. You don't have to update any of this. So back to the investor summary, we have a brief description on the top left. We have investment return metrics on the top right at a project level without debt, at a project level with debt, from the pref equity perspective, from the LP's perspective, from the GP's perspective. We have some general deal notes that'll auto-populate. We have sources and uses that'll auto-populate. Charts and graphs will auto-populate. You'll see here we're front-loading the equity. So it's not apples to apples, the sources of funds and the uses of funds graph. But if we go back to partnership returns and we say, hey, we don't want it upfront, we want it incurred now, you'll see, let's go to the investor summary. The uses doesn't change, but the sources change. And we have the sources of funds and then the uses of funds graph. Then we have the profit summary. So we'll showcase what the total, or I would say the gross sales proceeds look like, sales costs, net sales proceeds, all your other costs, and then you have your net profit. We have levered IRR, so it's saying base case IRR 30.85%, levered IRR, base case LTC 60% LTC, base case selling costs 8.5%. So what happens if we're not using those same figures, right? So 30.85 is what we expected, 60% and 8.5%. But what happens if we're at 65% and 9.5%? It's going to be 31.31, right? Or 55% and 9.5 and 7.5%. We're at 30.63. Then we have the construction loan notes, auto-populates, inventory loan notes, auto-populates. We have the sales schedule, so we'll break it down based off of pre-sales and then based off of post-TCO sales. And you'll notice this sales schedule chart will update automatically depending on what the sales schedule looks like. So if we go back to inputs, right now we're at detailed. If we go to custom, then we go back to investor summary, now it updates automatically. They're all sold pre-TCO. And we have a sample of the annual summary as well, year 2, year 3, year 4. So these are all going to be sold more or less in year 4. Or that's when they're delivered, I will say, which means they're off our books in year 4. So then we have the annual summary, construction schedule, draw schedule. It's just like the other annual summary, which we haven't gone through yet, actually. It's just like the monthly schedule, but less detail. And we can go to the annual cash flow tab, and this is what it looks like. Very similar to the CFTab, it's just on an annual basis versus a monthly basis. And then finally, we'll have the lender summary. The lender summary, it's going to be a snapshot of the project from a lender's perspective, and this will update automatically, and we can customize this depending on what you're looking for. So there's a brief overview of our premium condo development model. We can customize this out. We found that this framework and format works for a majority of our clients as at least a starting point. Very easy to use, very easy to update, and very easy to understand, I would say, most importantly. And if you have any questions, please feel free to reach out. Would love to walk you through it, or would love to talk about what specifically you might need for your project. Again, my name is Spencer Correnti. I run Alkaline Advisors, and I really appreciate you joining us for this video walkthrough. Hope to hear from you soon. Have a great rest of your day. Thanks.